Welcome to Swing Trade Pro, a three-part educational offering from Pivot Boss with Frank Ochoa. This is part 3 of Swing Trade Pro, Trade and Risk Management. While traders are usually more eager to learn about the next sizzling setup or indicator, true professionals know that the longevity in trading comes from managing the trade and managing risk. In this section, we'll be delving deep into trade management, from forecasting accurate swing targets to scaling and trailing techniques. Of course, we'll also cover some of the best risk management approaches that you can use in your trading immediately. By far, mastering the techniques in this course will do more for your trading than anything else combined. So let's go ahead and get started with part 3, Trade and Risk Management. The first section in Trade and Risk Management is forecasting accurate targets. Of course, we're going to look at everything from forecasting targets to scaling and trailing opportunities to ADR stops. I'm going to reveal the free trade technique, and then we're going to talk about putting it together and combining the various targets with trailing stops, scaling methods, etc. But basically, trade management involves everything, every aspect that goes into managing a trade, from targets, trailing stops, lost stops, scaling techniques, and more. Every single aspect has its own nuances, its own techniques, its own concepts, and we're going to look at every single one of those in great detail. After that, you'll have a very solid foundation of how to plan a trade management approach for your style of trading. In the first section, forecasting accurate targets, we're going to look at how I approach the market with price-based targets. The Pivot Boss approach to taking profits relies upon forecasting targets based on average price movement and utilizing actual profit targets. That's the number one thing here. For me, I had good trading results when I used trailing profit stops. But when I moved my philosophy to a profit target type of philosophy, where I used the majority of my trades had profit targets, that's when my trading really went up, because I was actually able to forecast high probability targets and play to those targets effectively while getting great trade location. And then after the trade was done, I was able to go on to the next setup and employ the same type of rules. So playing to profit target is going to be a very solid approach that we're going to be using here, but I'm also going to show you how I incorporate trailing profit stops when the time calls for it. Average price movement provides a price-based method to forecasting targets. That's important. Price is king. So when you're able to forecast anything, whether it's support resistance lines, targets, stops, anything based on actual price, you're going to likely have better and more reliable numbers to work with. Trading to high probability targets yields consistent results, and that is what happened in my real life trading. When I was able to identify high probability targets using the ADR method, what's now known as the ADR method, I was able to consistently book profits, and that is very important. Of course, using profit targets and using price-based stops based on ADR allows you to more easily incorporate risk management measures, which we'll talk about in the second half of this course. Trading to profit targets is the Pivot Boss preferred approach, but we'll be looking at how to trail price as well and scale at various points in the chart. So let's talk about pro-style techniques for forecasting targets. The two styles that we're going to talk about, basically they all revolve around the same method, but we're going to be looking at swing targets and weekly targets. And these are all based on average daily range, or the ADR method. What's great about the swing targets is, depending upon your expected trade duration, you're able to adjust the targets accordingly. So if you're looking for a 3-day swing trade move, you can get the targets for a 3-day bull or bear zone. You can also look for 5-day targets, 7-day targets, 10-day targets, 15-day targets, whatever the duration is, or the expected duration of the trade you want to trade, um, you can basically tailor the swing targets to those expectations. What I love about both of these approaches is that you'll notice that the bullet points are going to be the same for a lot of these that we talk about, because everything I teach is simple and effective. Everything that I teach is price based, which means they self-adjust to current volatility. When you have, the summer doldrums, you're going to have different targets that are projected that are likely going to be closer than normal because the volatility during that period of time is much lower. If we're talking about the beginning of the year where volatility picks up, or maybe in the fall when volatility picks up, the targets will be farther apart, and justifiably so, because trading activity will have picked up. And that's what I love about price-based indicators or price-based approaches, is that it self-adjusts to current market behavior and volatility. The thing about average ADR weekly targets is that you're able to identify targets for the week using the same type of concepts. So we're going to be looking at both of these in good detail right now, and let's go ahead and get started with ADR swing targets. ADR swing targets basically shows that you're able to forecast high probability targets based on average price movement. When you identify average price movement, you're basically using average daily range, right? That's average price movement. But you can also do so on a multiple day basis as well. So if you're looking at a 2 or 3 or 4 or 5 day multiple day range, then you're able to forecast targets 2, 3, 4, or 5 days into the future, given average price movement. And that's important. When we're looking at ADR swing targets, what was very important in my research was that the probabilities were consistent depending upon how far the target was away from current price. So if we're looking at certain targets, which we'll see here very shortly, some of these targets have an expectancy or probability rate of greater than 70%. If you go down into real-time or intraday trading charts, some of these were as high as 80 to 90% likely to be reached, and that's very important. But before we get started with ADR swing targets, let's first talk about average daily range and some of the other components that go into building an ADR swing target. So what is the ADR method? The ADR method is a simple yet powerful approach that is used for forecasting targets using average price range. And this can be done in any time frame. And that's important because I really like to teach concepts that scale across any time frame or any style of trading. So if you trade minute bars or if you trade weekly or monthly bars, you can use these types of targets, and that's important. What's great about the ADR method is it helps you forecast targets with a very high degree of accuracy. Again, the swing targets, some of these targets have a 70% potential of being reached. That's huge. The other thing is that if you're going down into a real-time time frame, some of these have an 80 or 90% chance of being reached, and that's very, very powerful. Others will only be reached 45 to 50% of the time, but at least you know this ahead of time and you can scale appropriately or only leave smaller position size to those targets. What's great about the ADR method is that it auto-adjusts to the current market volatility and behavior. Like I mentioned before, if you have quiet period of trading, like during the summer or maybe the holiday trading season, the ADR will self-adjust and the targets or stops that you use will be based on a lower volatility. That's very, very powerful stuff. The other thing is that this is simple, effective, it works. You can learn it very, very quickly and begin incorporating it immediately. If you are not currently familiar with the ADR method, then there are real-time and swing editions available at the Pivot Boss shop, and these two DVDs, one for real-time, one for swing trading, teach the entire methodology. What we're going to use here are the base calculations and also some newer concepts to help you identify some of these targets as well. So I'm throwing in a little bit of old, a little bit of new, but if you want the full method, you can also um, grab those additional resources as well. So why should you use ADR targets? Basically, average daily range has been used by professionals for years, and it's because average daily range provides a price-based approach that relies on current price behavior. What's great about ADR targets and why you should use them is because they provide simple price-based approaches that incorporates recent price behavior. They self-adjust to current volatility. They help provide reasonable price expectations for the upcoming period of time. And that's important because a lot of times novice traders have big expectations for their trades. Every time they enter a trade, they believe they're going to hit a home run. I know I did when I first started trading, but that's simply not the case. Can you imagine a professional baseball player going up to the plate and every time expecting to hit a home run? That's just not the case. Instead, a better approach to baseball is to always try to hit singles and doubles. Just get on base, because getting on base leads to runs. And that's just like trading. If you consistently hit to profit targets, like base hits, then you're consistently booking profits, which is like runs. Every once in a while, when you hit a single, it'll actually turn out to be a huge home run. And that's where the windfall profits come in, and you can adjust accordingly. But what's great about the method is it provides reasonable expectations for where price is likely headed, and that's huge. The other thing, the method or targets allows you to easily forecast bull and bear targets regardless of time frame. So there's a lot of versatility here. If you use, like I said, 60-minute charts, or if you use 1-minute charts or weekly time frame, you can still use this approach. And of course, allows you to anticipate market behavior, including breakouts and range markets. That's the other thing about ADR, or average price movement, is that during expansion and compression phases, indicators like ADR can help you identify when to expect big moves or quiet markets. So there's a lot of volatility to this approach, or versatility to this approach. So what is ADR? ADR is average daily range. Average daily range is calculated by averaging the sum of the daily ranges over a given period of time. So daily range refers to the high minus the low of a day, including the extended hours trading. ADR refers to averaging the daily ranges over a string of days. It's just like a moving average. So the ADR method primarily uses a 5 or 10 period ADR calculation, which is similar to a 5-period moving average or a 10-period moving average. ATR, average true range, can be substituted for ADR, but just know that ATR includes gap data in its value calculation, which means that an ATR value will almost always be higher than an ADR value. And that means the targets will be a little farther away. And that also means if they're a little farther away, you're not going to reach them as often. So let's talk about calculating the ADR through this graphic here. What you see is days 1, 2, 3, 4, and 5, and these are daily bars. Day 1 has a range of 44.25. From the high minus the low is 44.25. Day 2, 25.75. Day 3, 23.75, and so forth. When you have 5 days in a row and you take the 5-period ADR, you're basically averaging the 5 days of price range. And when you average the 5-period price range like that, it gives you a value. So after these 5 days, you average them out, it gives you an ADR, a 5-period ADR of 29.45. And what that does, that 29.45 allows you to forecast what the upcoming day's potential price range could be on average. That means if the upcoming day trades on average what it had been trading in the last 5 days, it will trade on or around 25.45 points, or 29.45 points. If you look at actually what happened, day 6, that day's price range turned out to be 32.25 points. So if you were able to identify the high or low for the day, here's the high, and project lower by 29.45 points, you would have hit a target that was only less than 3 points away from the day's low, and you would have netted a very nice gain. So that's how you calculate ADR. You look at the daily ranges over a string of data, average them out. And once you have the average, you're able to forecast targets in either direction. Now let's talk about multiple day ranges. This is basically ADR's cousin. And a multiple day range is just like ADR, only it looks at the range over a given number of days. So like over the course of 3 days or a 5-day period, what is the highest high and the lowest low over that 3 or 5-day period? That's a 3 or 5-day range. Now if you look at the ranges, multiple day ranges going backward in a string, you can then average out what the average multiple day range is. So when you look at the highest high minus the lowest low over a string of days and average that out, it gives you, again, just like ADR, a value that you can project higher and lower to determine with very good odds what the upcoming price range could be if price were to rally or sell off. So the MDR and its average is used to identify great swing targets. Again, the ADR method primarily uses a 3 and 5-day calculation, but other periodicities can be used, like a 10-day. And when we're looking at swing trading, when we're talking about swing trading, obviously you're looking at 3 to 5-day moves, even up to 2-week moves. A 2-week move would be a 10-day calculation. If you want to look farther than that, into the future, you can do a 15-day calculation or a 20-day calculation, and you'll see in the rest of this course here that we mix in 3, 5, 7, 10, 15-day calculations, because again, it's all about the trade expectancy. How far do you think this trade might go? And then of course, once you have that idea, because if you're in an extended markup phase and the average swing in a markup phase is say 12 days, you can run a 12-day calculation and then forecast that from a recent pivot high or low and get some great targets. So let's talk about MDR price forecasting. While we just mentioned how to look at an MDR, what it is, forecasting is something that you can do regardless of time frame again. You can do this all the way down into minute bars, and you can do it as high as monthly charts, or if there's a price bar, regardless of the time frame, you can forecast with multiple day ranges. Multiple day ranges provides reliable price extremes for the upcoming n number of days. So if you have say you're trying to forecast a price range for the next 10 days, you can use a 10-day multiple day range calculation and forecast a price extreme higher and lower from a prior closing price. That gives you the anticipated price extreme for the upcoming period of time. That means that price is likely going to stay within that window given recent average trading behavior. And that's very important. Again, it tempers your expectations on how far price can go. Regardless of direction, bull and bear targets give you great approximations for your trades. So with MDRs, you're able to forecast bull and bear targets with this forecast, or with this MDR value, and we'll look at that in a moment. The method takes into account abnormally high and low range MDRs as well, which allow you to forecast better targets. So in the actual ADR method swing edition course, we also talk about range-based targets, which allow you to forecast farther targets or closer targets based on abnormally high or low range MDRs. We're not going to talk about that here, but just know that you are capable of doing that with MDRs. So visually, let's look at how we calculate a multiple day range. The multiple day range calculation uses a rolling method whereby the oldest day in the string is dropped when a new day is added. So if we look at the illustration here, you see if we're calculating a 3-day range, 1, 2, 3, then we look for the highest high minus the lowest low of that 3-day range. That is your 3-day range. Now, when day 4 begins to trade and is finished trading, we then drop the first day in the string and add the newest day. So we drop day 1, and then we add day 4. And that gives you the highest high and the lowest low over that 3-day period. That is your new 3-day range. And then we go to the next one. Day 5 is finished trading. We drop day 2, add day 5. We have a new 3-day range. And so on and so forth. We go through the string. Now we have 3-day range, a 3-day range 1, 3-day range 2, 3-day range 3, 4, and 5. Now we have a 5-period multiple day range. So when we're looking at calculating the average MDR using that data, this is what you get. For 3-day range 1, it was 26.25 points. 3-day range 2 is 37, 60.75, 57, 45 half, etc. Average those out, and you have an average 3-day range of 45.30. If you look at the numerical formula here, you can see that all it is the highest high value over the last 3 periods minus the lowest low value over the last 3 periods, averaged out for 5 periods. Average. Do you want to do a 10-period average of the 3-day range? Put a 10 here or a 20 here. Just know the smaller the number that goes here in terms of how many periods you're smoothing this out on, the more accurate it's going to be in terms of calculating or incorporating recent market behavior, recent market price volatility. But when you have this 3-day range calculated as a 45.3, you can then use that information to forecast potential targets. So if you look down here, forecasting with MDR, the 5-period average 3-day range of 45.30, what does that tell us? It tells us that the 45.30 indicates that the price range of the upcoming 3 days should be around 45.30 on average. In the actual example above, this was taken the ES several months back, the price range of the upcoming 3 days was actually 46.50. So we were able to identify the price range of the upcoming 3 days in the future with a very high degree of certainty, within 1.2 points. That is fantastic. And that's the power of forecasting with average price range. Of course, I mentioned right here on average, because on average, that indicates that price moves averagely all the time, which of course it doesn't. That's why there are light calculations which only take a percentage of average, which indicates that you are more likely to reach those targets than the actual target that is averaged out, because markets don't move in average amount every single time. If the 10-day average price move was 10 points, that means tomorrow it's going to move 10 points, and the next day will move 10 points, and the day after will move exactly 10 points. But that doesn't happen. Instead, sometimes you move 8 points, sometimes you move 12 points. Sometimes you move 9 points, sometimes you move 11 points. But it all averages out to 10 points. So when you're using multiple day range averages here, just know that the actual average isn't the primary target. It's actually used as a secondary target. And we'll look at those illustrations here very soon. So using multi-day ranges, the swing edition of the ADR method uses 3 and 5-day ranges to forecast targets, but 7 and 10-day ranges should also be used. After all, if you're swing trading, you want to trade a 1-week move, sometimes you want to trade a 2-week move. If a markup swing cycle is lasting 3 weeks, you might want to trade a 3-week move. That's a 15-day MDR. So you can adjust these accordingly and according to your trading style. The 3 and 5-day ranges help forecast swing targets 3 and 5 days out. The method projects the expected range over the next 3 or 5 days according to recent price behavior, which means you're factoring in the most recent price volatility, and that's always important. Now let's look at the base calculations that we're going to be using to forecast swing targets. We're going to utilize the two base calculations from the ADR method, which are normal and normal light. The normal calculation forecasts 100% of the average MDR, while the normal light calculation forecasts only 75% of the average MDR. And for bull targets, you're going to be projecting the MDR higher from the first day low or the entry bar low, whereas the bear targets are going to be projecting the MDR value lower from the first day high or the entry bar high. Remember, I talked about accuracy or probabilities of being reached. The normal calculation has an accuracy of around 45% of being reached, whereas the normal light calculation has somewhere between 70 and 75% accuracy. So you're going to use the normal light calculation as a primary target each and every time. On the other hand, the secondary target should be the normal calculation. And of course, you can scale at each of these values as well. Let's look at the normal calculation, how it's calculated, and of course, let's look at what the targets look like on the actual charts. So the normal calculation projects the average MDR higher from the first day low and lower from the first day high. So if you look at the illustration, you can see this is the entry bar or the signal bar, the pink or fuchsia bar here. We're going to look at the first day low, that's this bar, and project higher the average MDR. When you project it higher, you'll get a target, and you'll see, more often than not, you're going to reach these targets. And of course, a normal calculation projects 100% of the average MDR. So if we look at this on the chart, let's look at a 10-day multiple day range. The 10-day MDR for this particular chart was 1.63 points. That means, on average, that this stock chart moved 1.63 points every 10 days on average. So if you see on this example, we're breaking out of an accumulation phase. That indicates we could see a very nice markup period. We have a very nice bull candle here, so we use our retest entry right at the center of that candle. That gives us an entry of 32.36. Since that's our entry bar, we look for the low of the entry bar, and then we project higher the 10-day MDR of 1.63, and that gives us 33.80 as a bull target. And you can see it was reached it took 1, 2, 3, 4, 5, 6, 7, 8 days to reach that 10-day target, which is fantastic. Now, of course, when we're looking at getting a 10-day MDR, we're using the advanced ADR calculator, setting it to a 10-day look back over the last 5 or 10 periods. And when we're doing that, we're taking the latest value of the most recently completed bar, which means if we're trading this bar, this would be the bar where you take the MDR value from. The 10-day MDR value would come on this bar. Now, when we project higher from the first day low, it's very important to get a great entry, because we're going to be looking at using ADR stops as well. And the better your entry, the more precise your entry, the better off you are toward maintaining a great reward-risk ratio, which we're going to talk about later on as well, and also positioning yourself to getting in at the earliest part of the move in order to enjoy the maximum benefit from that target. Here's another example. This is Chevron Corp. And if we look at this daily chart, we can see that the MDR value, the multiple day range, the 7-day range average was 4.38. Now, if we look at our entry here, you can see that price dropped right into the Pima pullback setup. We have a very nice reversal wick here. We put our entry right at the center of that wick, which makes our entry 105.58 on the tail of this bar. And then we find the low of that day, which is 105.28, and project higher 4.38 points, which is the 7-day multiple day range average. And you can see it was hit A total of 1, 2, 3, 4, 5 days later it was reached, which is fantastic again. Now let's talk about the normal light calculation. The normal light calculation projects only 75% of the average MDR. And it projects the 75% average MDR higher from the first day low and lower from the first day high. Again, this is very, very similar to the normal calculation. The exact techniques are used. The only difference is that average MDR, we're multiplying it by 0.75 in order to lighten the distance just a hair, because we know that the markets do not trade in perfect averages. Sometimes they fall short of the average, sometimes they exceed the average. So if we drop down the calculation just by a little bit, in this case by 25%, we're more likely to reach our target. As a matter of fact, we're 70 to 75% likely to reach our target. So if we look at this on the chart, you can see this is the same exact example we saw in the first normal example. And you can see here after we get in, here's a 32.17 low again. There's our entry at 32.36. The 10-day MDR is 163 again. All we do is multiply 1.63 times 0.75 and project that value higher from 32.17, and that gives us a normal light bull target of 33.39. Again, that was reached 1, 2, 3, 4, 5, 6, 7 days. So a 10-day, multiple day range normal light target was reached in 7 days, and it gave you a very nice gain of over $1. Let's look at the normal light applied for the PowerShares QQQ. This is a short trade that's bouncing off of VWAP. You can see that we had a very nice move into VWAP and it began to roll over just a hair. We decided to put our entry at the center of this bar. When price came up, we were filled at 67.94. We then find the high of this bar to be 68.08 with a 10-day MDR of about 2.9 points. We can then project that figure lower, 75% of that figure lower, and that gives you a normal light bear target of 65.90, which was actually reached a couple of days later because we had a huge windfall bar here that was the range of at least 3 or 4 normal bars. Either way, your target was reached. Now let's talk about average weekly targets. So the average daily range can be used with weekly bars, which actually means it's an average weekly range, right? So instead of average daily range, it's average weekly range, which means you jump up into a weekly chart and you use the same metrics you would normally use. You do a 1 day, 10 period, weekly average. And that helps you forecast reliable targets for the upcoming week. So what we're doing here is we're actually using the very same calculation method, only we're using weekly bars. You can see here, this is Monday, Tuesday, Wednesday, Thursday, Friday. Here's the beginning of the calendar week, right here. And what we're going to do is we're going to look for the low of the week, the upcoming week, right? So this is Monday. And if Monday forms a bar like this and it has a very nice low that we feel confident will be the low for the week, project the average weekly range higher from that zone, and that will give you the expected weekly range extremes to the upside and the downside. Average weekly range is calculated exactly like average daily range, only uses weekly bars instead. So what we're looking for is the high minus the low on a week-to-week basis. Average weekly range refers to averaging the weekly ranges over a string of weeks or months. So if you're using a 10-period average weekly range, 10 periods means you're looking back 10 weeks. But when you're doing that on a weekly chart, it's only 10 bars, right? So if you look back at the last 52 weeks, so if you do a 52-period average weekly range, you're looking to see what the average weekly move was over the last year of trading. Now, I wouldn't suggest using that in your actual trading because that's too much time. The market changes way too fast to use a yearly calculation. That's why I only use a 5 or 10 period calculation, because that's using the last 5 or 10 weeks of history, which is the most recent that you can use for the current market environment. Average weekly range forecasting and targets. Like multiple day ranges, average weekly range helps temper expectations for price range and provides a price-based method for forecasting targets for the week. So what I like about average weekly range is that you're able to forecast a potential price extreme for the upcoming week before Monday's trading even begins. And we're going to talk about how to do that. Identifying the potential price range for a given week helps manage price range expectations. It helps manage your expectations for how far price will likely move in the upcoming week. After Monday's trading is finished, you can then project the targets from Monday's high and Monday's low to give you very solid targets for the week. Now, if a confirmed high or low for the week is formed sometime during the week, then you're able to pinpoint the best targets, the most accurate targets, because you have a confirmed high or low to work from. So again, we're going to use the base calculations for forecasting average weekly range, which are normal and normal light, which is 100% of AWR and 75% of AWR. And we're also going to talk about the initial forecast. And the initial forecast is when you project the average weekly range higher and lower from the prior week's closing price. So you forecast the entire 100% average weekly range higher from the prior week's close price and lower from the prior week's close price to determine your range expectations for the upcoming week. And we project a full 100% because we want to know what the actual range looks like, so that when we put it on our charts and we look at the trade that we're trading or potential trade we're going to get into, we have expectations on where price is likely headed given average price movement over the last 10 periods or 10 weeks. Let's look at an example here. Here's an example of international paper. We have an average weekly range of 2 points. This average weekly range is used over the last 10 periods, and what we're looking at is we're looking at this range. For example, here's the first week in December. The high was 37.5, the low was about 35.25. That means a range of 2.25 points. Now if we look to the left, this time period here gives us a range from 35.75 up to 37.5, something like that. 1.75 points. So this one's 1.75, this is 2.25, that averages out to 2. You can see how average weekly range works. Now, to get the initial forecast, here's Friday's price activity. The upcoming week hasn't even started to trade yet, but here's Friday's close, which is 36.04, prior week's close. 36.04, forecast average daily range of 2 points higher. That's 38.04. Forecast it lower. That's 34.04. Now we have a very good basis for where average price movement should put price if the stock trades on like it normally does. Now, we are in an established markup phase in this stock, which means we've been trending up and up and up. And on this pullback, we're expecting this to be a pullback buying opportunity that leads to a new high. So our anticipated price movement will be up toward the top of this range. If a failure occurs, then we would expect price movement to drop down to the bottom part of this range. So that's why we have two sides here, even though we only believe that price will be moving up. But this gives us a very nice initial forecast to watch for. Now that Monday's trading has printed, you can see Monday's bar is now there. We can use Monday's high and Monday's low to forecast the actual weekly targets. We forecast higher from the Monday's low, 2 points, right? Average weekly range. Forecast that higher from 35.86 and you get 37.86. Forecast 2 points lower from Monday's high of 36.37, and that gives you 34.37. That's your normal target bull, normal target bear. Now, if we take 75% of the 2-point AWR, that's 1.5 points. Okay, so forecast 1.5 higher from Monday's low to get 37.36. Forecast 1.5 points lower from Monday's high of 36.37, and you get 34.87. So now these are your bull and bear targets for the entire week. Now, if Monday's market opens here and puts a new low wick in and then closes higher, we can then adjust our targets accordingly by using the new low and then forecasting those ranges higher. So you have to wait to see what happens. If a new high or low pops into the chart over the next couple of days, use that new figure to readjust your targets. Now we can see what actually happened with price movement. Here's Tuesday, Wednesday, Thursday, and even Friday's market, and you can see that price did indeed continue to push higher, and it pushed right into the normal light target, and a day later reached the normal target. But you can see that price did indeed trade in the manner in which we expected, right? As a matter of fact, if I overlay the initial forecast onto what really happened and over the actual weekly targets, you can see that it put us right in play for what was likely to happen. The top part of that price extreme is right where price closed the week. Look at where price closes the week, right at that zone. The high was just beyond it, but it put us in a very good spot to trade with maximum efficiency. This is where we're headed, so we know to put our target here, or both to scale out, and we got the move, right? And now we focus on the next opportunity. All right, let's talk about ADR stops now. ADR stops provide the trade risk portion of our trade management, okay? Where do I set my stop? How do I set my stop? And what I'm going to do is use a very, very simple approach. I'm going to use average daily range to help us identify our stops. And this is a professional approach that a lot of former floor traders and current floor traders use, hedge fund managers, managed futures funds, etc. I know a lot of big players in the game, and this is a very simple approach they use. But you'd be surprised how simple the techniques are that they use. I actually had a former trader of 30, 35 plus years contact me after he read my book, and the thing he said was, finally someone wrote about all of the different things that I learned when I was trading for the big boys. And that was fantastic. It really helped to reinforce the concepts that I teach in terms of simple concepts, price-based concepts, concepts that just make sense and are easy to implement. And that's what this ADR stop is. It's a simple and effective approach to managing risk on your trade using average price movement. And all we're going to do here is identify a 5 or 10 period ADR, a single day ADR, and then take half of that ADR and project it lower from our entry price or higher from our short entry price. And that's it. Very simple. So ADR stops use 50% of the 5 or 10 period average daily range. So before the session starts, you look to see what the most current ADR value is over the last 5 or 10 periods. You have that value handy for the trade, for the stock you're going to trade. And since that value is not going to change the rest of the day, that's the value you will use for every trade you take in that stock on that day. So if the average daily range in some stock is, say, $1, you're going to use a 50-cent stop. If the average daily range in the ES, for example, is 13 points, as it is right now in the market, your stop will be 7 or 6.5 points. right? But remember, while 6.5 points is a lot for the ES, these are swing trades. Swing trades. So it provides enough room, yet it provides a very decent risk metric that basically, if you hit it, it's not that big of a loss, especially if your trade location is on point, which it will be after watching and mastering part 2 of the course. So with ADR stops, these allow you to define your trade risk according to the most recent price movement. Again, average daily range is average price movement. These allow for easy integration with your preferred risk management approach. For example, we're going to be talking about the 2% rule later on. These allow you to incorporate the 2% rule very, very easily and quickly. Also, if you're using this approach, you can easily use any reward risk ratio that you would like, and it's very simple to calculate. We're going to use 50% of ADR, and we're going to calculate these stops every single day for whatever instrument that we're going to trade before the market opens. So let's look at a quick example. This is Chevron from earlier. The ADR, 10 period single day ADR, which means price in this stock moves 1.91 points per day on average over the last 10 periods. So if this is our entry bar, that means that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These 10 bars, all these green ones, and then this red one, these 10 bars make up that 1.91 ADR period value. Okay? If this is our entry bar, since this actual day has not yet finished trading, what we have here is basically an unfinished ADR value or calculation. So what we do is we use the last full day where that value was calculated. So we're going to take the ADR, the 10 period ADR value from this day, and use it in our trading on this day, right? So if we get a great entry, again at the center of this wick, our entry is 105.58. We take the 10 period ADR calculation, 1.91 points, and divide it by 2. That gives us 96 cents. We project lower 96 cents, and our stop is 104.62. Very simple. And you can see I have the normal bull target here of 109.96. And if we use a target like this with a stop like this, it basically comes out to a 4.5 to 1 reward risk ratio, which is a very healthy ratio. All right, let's look at ADR stops for QQQ. You can see here that on this chart, just like what we saw a little while ago, it came right into VWAP. We got our entry at 67.94. The 10 period ADR value was 0.76 points. Again, if this is our entry, we're looking at this bar's ADR value. And it's looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Those 10 days to see what the average price movement was for each day. The average price movement was 76 cents. We take half of that as 38 cents. That's our stop. So if we get a great entry here like we did at 67.94, we add 38 cents to it to give us 68.32. That's our stop. Again, here's our bear target, which was reached at 65.90. Look at the reward risk ratio on that. Again, it's another 4 to 1 reward risk ratio. Great, great ratio to trade by. All right, now that we've finished calculating our targets, calculating our stops, let's talk about scaling and trailing techniques. Using high probability price-based ADR targets provides the flexibility to scale and trail position in a variety of ways, and that's very important. You always want to use tools or concepts or techniques or ideas that allow you to use them in multiple ways, because then they become like a Swiss Army knife of trading techniques. You can use them in a variety of ways given whatever is the best approach to use that method in for the current market environment. Using high probability based ADR targets is always a great idea because they have a very good expectancy of being reached. Now, if you're scaling at various targets, it only adds to the power behind these targets. And if you're trailing using these targets as well, or in combination with these targets, you're able to do very, very well. So when we're talking about scaling, we're going to be using 2, 3, and 4-part scaling techniques at various ADR targets. When we're talking about scaling benefits, basically scaling provides flexibility, reduces your risk, helps create a habit of continuously booking profits, and of course, scaling helps to improve the trader psyche. If you're consistently booking profits, then you're consistently happier as a trader, right? Also, if you're scaling out of a trade, you're reducing your risk on that trade, sometimes even getting a free trade, which does wonders for your trader psychology because you're then allowing the trade to run its course because you have no risk or very little risk left because you booked your profits along the way. Remember, hit singles and doubles and they will lead to runs over and over again. So the scaling techniques that we're going to talk about here help provide great benefits that we just discussed, like risk reduction, consistently booking profits, and improving trader psychology. There are various scales that we can use, 2-part scales, 3-part scales, 4-part scales, and it doesn't really matter which approach you use. I've provided a ton of different scaling ideas and options, and I'll tell you why I like certain ones over others, but of course it's up to you to figure out which scaling approach works for you, should you even want to incorporate a scaling approach. Now when we talk about a 2-part scaling approach, that's basically selling off your position or liquidating your position in 2 parts. The first part and a second part. So with a 2-part scaling approach, you can sell half at a target and sell the rest of the half at another target. Or you can sell 2/3 of a position, then 1/3. Or you can sell 1/3 first, then 2/3. 1/4 first, then 3/4 later. 3/4 first, or 1/4 later. Or you can scale at half and then trail the last half. So you can see there's various ways to do this. Now, my preferred approach when I trade, if I'm scaling out of a trade and I know I'm going to scale, then typically what I do is I take the bigger load first at a high probability target. So I will take a 3/4 off the table at a high probability target and then let the last quarter trail to the secondary target. Or I'll do a 2/3 at the high probability target and then a 1/3 at the secondary target. That's usually my preferred approach because I want to be able to take off the biggest bulk of the trade at the target which I know has the highest expectancy of being reached. But another thing I can do is I can trade the biggest bulk on the back end to that same high probability target, but scale out earlier in the trade just to reduce my risk and give myself a free trade of sorts. So it just depends on the trade, the circumstances and scenario on which one I'll use. But for the most part, when I provide options like this, just know that I trade one option the majority of the time and then mix in the others when I can. So you can do the same as well. Now let's talk about 3-part scaling. This is when you liquidate your trade in 3 different scales. For example, selling a third and then a third and then a third. Or you can do a half, a quarter, 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 half, quarter, half, quarter, 2/5, 2/5, 1/5, or you can do quarter, quarter, trail, half. I mean, I can keep going and going as well. But there's so many different ways that you can do this. Again, I like to scale in a way where I am scaling out of the bulk of my position earlier than later. So one of the ways that I scale, if I use a 3-part scaling approach, is I will lighten the load with a quarter at an early target. Then I'll sell the bulk of the position, half of it, at the most highest probability target, and then I'll let the quarter ride to a secondary or tertiary target. That's usually my preferred approach. The other thing I can do is go 2/5, 2/5, 1/5. So I'll do this one at a high probability target, this one at another potentially high probability target, and let the last be a flyer. In a 4-part scaling technique here, what you do is you liquidate your trade in 4 different parts. For example, a quarter, 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 quarter. Or you can go a fifth, fifth, a fifth, and 2/5, or you can do the 2/5 earlier and the fifths the rest of the way, or you can do quarter, 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 and trail the last quarter. So again, there's a whole lot you can do here, but the idea is that you have an approach that you're comfortable using. Now, I don't typically scale 4-part scales. Some people scale 4-part, 5-part scales, etc. I usually stick to 2 and 3-part scales. Of course, if you trade size, any amount of size, if you're trading 5 contracts or more, I would consider a 4-part scale. If you're trading 10 contracts, say, you can lighten the load with 4 contracts early and then scale 2, 2, 2 after that. So it just depends on your approach, your style, and your scenario. So let's look at a couple of charts regarding scaling. Here's a 2-part scale that I like, and basically a sound scaling approach, which I just mentioned in the prior slide, involves selling the bulk of your position at the target with the highest odds of being reached, and then letting the last portion of your scale go to a secondary target. So for example, here's the same trade we had earlier. If this is the entry at 32.36 and we have a 10-day MDR average that we're using, we can then find our normal light and normal bull and bear targets, right? So here we are with our targets. And what I'll do is if I'm in this trade at 32.36, I'll take 3/4 of my trade off at the normal light target because I know this target has between a 70 and 75% chance of being reached. So I want the biggest part of my position off at that zone. And then I know that the normal bull target here has around a 45% chance of being reached, up toward 50. So I'll let a quarter of that trade stay on for that target. In a 3-part scale, this is another way that you can do it. This is a way that I would advocate if you're trading for longer and longer targets. Basically what you're doing here is you're using a mixture of different durations of MDR targets. So you might use a 5-day target, a 7-day target, a 10-day target. And for each of those 5, 7, and 10-day MDR targets, use the normal light calculation. Because remember, the normal light calculation has the highest odds of being reached. So what you would do here is my entry is 81.08. Here's a pullback within a markup period. We got a very nice reversal setup here, whereby we got a big slam down bar, then we formed a very nice wick. We got in at the midpoint of this wick on this doji bar at 81.08, and now we can forecast a 5-day normal light target at 82.88. I'll sell a quarter there. Then we forecasted a 7-day normal light target of 83.39, sell half here, and then you can sell the last quarter at the 10-day normal light target of 65.90. So you see how I've mixed in the different durations of MDR targets in order to scale at the various targets. All right, let's look at a 4-part scale with Citigroup now. If the expected trade duration is longer than usual, then scale out at the normal targets earlier in the trade. For example, this Citigroup had been in a bullish phase here. You can see the PIMA moving averages are stacked in slope. We're in a markup phase. Every swing high in this markup phase has lasted between 10 and 15 days. Now, when it lasts between 10 and 15 days, and you know you're going to be playing to a 10-day or 15-day target, well, if you're scaling earlier in the trade at 3 and 5 days, instead of using normal light during those scenarios, use the normal calculation. Because if you're playing for a move way up here, then you're going to reach your normal targets. So there's no use in shortchanging yourself on the target from normal and normal light. So if this is our entry, right, So here's our nice reversal candlestick. We got a very nice push up. We move our entry toward the middle of this wick here. We get in on this doji, 32.74, forecast a 3-day normal target, sell a fifth here, and sell a fifth here at the 5-day target. See, since the duration, the expected duration of this trade is supposed to be upwards of 15 days, lighten the load early on with a smaller portion of the scale, and then sell the majority portions of the scale later on in the move. For example, right here is a 10-day target that was reached. Sell 2/5 of your position and then leave the last fifth on for the 15-day normal light. So up here, we use normal lights. Down here, we use normals. All right, let's talk about the free trade technique. This is a technique that I think you're going to really, really like. Basically, this is not a new technique. It's something that I learned many, many, many years ago, and it's basically common knowledge among a lot of professional traders. The thing is, what's usually common knowledge among professional traders is not always common knowledge among other traders. So if you have never heard of this technique, this is something that I believe you should incorporate in your trading in some manner or fashion, especially if you're a trader that's still struggling with consistent profitability. So the free trade technique is basically a two-part scaling technique that allows you to position yourself with a risk-free trade after an initial favorable move. And what that means is you're able to use a conservative two-part scaling approach, to acquiring a free trade. And I'll tell you what that means in a moment. Basically, this free trade, by using this two-part scaling approach, provides a defensive approach to trading and scaling. So again, for markets that are very volatile but you want to dip your toe in the water anyway, this is a technique that you should consider using. If you are still not a consistently profitable trader and are working toward becoming a consistently profitable trader, you can incorporate this technique for every trade you use. And it's not a get-rich-quick technique, but it's a technique that teaches you how to manage your risk, manage your trade in a way that you are not losing money. You're just not printing money very quickly, but your equity curve, your bottom line are moving up. So it allows you to proceed with caution in volatile markets. It allows you to dip your toe in the waters if you're unsure but want to take a try on a flyer. It allows you to be defensive about your approach. Maybe you're hit a rough streak in your trading and you had been making money over the last 6 months, but the last 2 or 3 weeks has led to a drawdown in your account. This would be the time to use the free trade technique, because it will stop the bleeding and it'll get you back to the basics of trade and risk management. So let's talk about the free trade technique and what it is and how to implement it. Basically, there are 5 steps to it. Actually, 4 real steps. Step number 1, calculate your risk on the trade. Your risk on the trade is basically your entry price minus the stop loss price. Okay? Number 2, project this amount higher from your entry price. So say you are going to get long a $30 stock. Your entry is $30 and your stop is $1 lower at $29. You would project that $1 risk amount higher from your entry. So now that's your free trade zone. $31 is your free trade zone. That's 30 plus the $1 of risk. When price reaches the free trade zone, sell half of your position. So when price goes from $30 up to 31, sell half of your position. Number 4, leave your original stop for the last half of your position. So now what's happened is you've completely eliminated the risk from that trade, because if you have, say, 200 shares, you just went long 200 shares at $30. You sell 100 shares at $31, that last 100 shares, if it goes all the way to your original stop loss, you have a break-even trade. You lose no money. But if it continues higher, in your direction, you make money, right? So you now have a free trade. You lose no money if you are stopped out on that trade. All you have is potential winnings ahead of you. That's how you get a free trade. Sell half at your free trade zone. Leave the last half with your original stop and then see what happens. Let it trade and see what this does to your mental makeup, your psychology of trading. Is it says, I now have a free trade. I can walk away. I can go have lunch. I can do whatever I want for the next few days, and I know I won't lose money for the most part, unless some kind of flash crash happens or a ginormous gap occurs. But for the most part, you have a free trade on your hands, and you can let it take as much time as it needs to get to your targets. So let's look at a couple of free trade examples here. Example number 1, risk per share is $1.50. That's your entry price minus your stop loss price. The free trade zone is then $42.50, right? Minus that $1.50, because this is your entry of $41. $41 is your entry. Add that $1.50 risk per share. That gives you $42.50. When price reaches $42.50, sell half the position at $42.50 and let the last half ride with the original stop of $39.50. You have a free trade. Number 2, risk per share. If the entry is $21.75 and your stop loss is going to be 75 cents, project that 75 cents higher from the $21.75 entry to get $22.50. That's your free trade zone. Now when price reaches $22.50, sell half of your position and keep half with the original stop of $21. You now have a free trade. Basically what we're learning to do here is we're learning to trade with house money. Learning to trade with house money. And that's very important and a very powerful concept. Let's look at an actual example on the chart. So if we have our entry here of 105.58 in our Chevron example that we've used a few times here, this is your ADR stop. Remember, the ADR value is 1.91. We divide that by 2 to get our ADR stop of 96 cents. Here's our entry. We drop down 96 cents. That's our ADR stop, 96 cents. Project 96 cents higher from the entry, and your free trade zone then becomes 106.54. When price gets there, sell half of your position and keep the last half with the original ADR stop. That's a free trade. Now if price drops down here and stops you out, you've lost no money, no reason to be mad, unhappy, sad, because you lost no money, you gave it a good shot, you did exactly what you were supposed to do. You followed your rules and did exactly as you were supposed to do. Now, if price does push higher, then you obviously make money on that second half of the trade, right? Second half of the trade, plus you made money on the first half, even if it was by a little, right? So what this does is it frees your mind. It opens your mind. It removes all worry and fear from your mind, and you can then let price do whatever it wants because you have a free trade. So you can trade right to the normal bull target and reap those benefits. Or if we're in an established markup phase and you believe that we're going to be trending higher for some time, then you have a free trade. Take off all your targets and just let price go higher. And look at this. 2 weeks later, 3 weeks later, we're now dancing around 113.55. All because you were able to get that free trade and free your mind. That's fantastic. Now let's look at another example, this one in QQQ. Basically, this example here shows us that even in a short trade, even in a trade that's, again, in a very nice markdown phase, we're able to employ the free trade technique very easily because it's all just based on price, based on actual money management rules and techniques. So what we're able to do here is we see the entry at 67.94, right? We calculate our ADR stop to be 68.32 because the 10-day ADR is 76 cents. 76 divided by 2 is 38. 38 plus 67.94 gives us 68.32. Now we project those 38 cents downward from the entry to give us a free trade zone of 67.56. So we get in the trade. Later on in the trade, we actually trigger during that same day and we sell half of our position and leave the rest with the original stop. We have a free trade. Now we sit there and collect money the rest of the way. As I told you, this technique is a defensive technique. It's a cautionary approach to trading, but an approach that I believe most novice, inexperienced, inconsistently profitable traders should use, including myself at times. Because even when you hit a rough patch in your trading where you begin to experience some drawdowns, you're not reading the market as well as you could, the market volatility has shifted and you haven't quite caught up yet, start using this technique because it will stop the bleeding, but you're still in the game. Again, since you have a free trade here, you can even drop your targets and just let price do what it does. If you're in a markdown phase that's clear and established, you're likely going to continue to remain in that markdown phase. And you have a free trade, and that's all you can do is just sit there and reap the benefits. All right, let's talk about trailing stops now. Trailing stops, as I mentioned before, are not my preferred method of trade management. As a matter of fact, playing to profit targets is my preferred method of trade management. However, trailing stops, when used at the right times, can have a huge impact in your trading because it can help you take advantage of windfall profits. Right? I mean, taking advantage of those glorious trending opportunities can't really be done with targets, but it can be done with trailing profit stops. So when we talk about trailing profit stops, we're going to use an ATR-based approach. Remember, ATR is very similar to ADR, only ADR does not incorporate gap data or information, whereas ATR value does. ATR is basically it's basically the default approach for using trailing stops in any trading program that you use. So it's a very simple way to just go ahead and start using ATR values for trailing stops because it's most likely it's already built into your platform. So when we look here is trailing stops, these provide a consistent approach to trading, and they also provide an approach that self-adjusts to current volatility. Just like ADR, the reason ATR was such a big hit in the early 90s was because everyone loved the fact that it self-adjusted to current market volatility. So what happens here is you're able to use a 1 ATR trailing stop for short to medium term trades, or you can pump that up to a 1.5 to 2 ATR trailing stop for long-term trades. And I know this is basically a swing trading course, but I'm going to show you a couple of techniques here that can help you garner a larger position trade if the scenario warrants it. So let's talk about some trailing techniques and tips. As I mentioned before, trailing stops can be a very powerful part of your trading. And knowing how to use them creatively can be the huge advantage. So number one here, use a 1 ATR trailing stop for most of your trades. So for most of the swing trades that we're going to do, you're going to use a 1 ATR trailing stop. If you want to capture a bigger or longer term move, use a 1.5 to 2 ATR stop and consider moving to a weekly chart. For example, if we're breaking out of accumulation phase, drop into the weekly time frame and trade the move out of the weekly chart, out of that accumulation phase, and you're less likely to be whipsawed out of that move as it moves into an accumulation phase. And you can use your 1.5 to 2 ATR trailing profit stop. You can also consider using a trailing stop at the beginning of a new markup or markdown phase. So as soon as you know that you're transitioning from an accumulation or distribution phase into a markup or markdown phase, use a trailing stop from the beginning, and you're likely going to see that you're going to take advantage of that move, that initial thrusting move, because as we all know, the beginning part of a markdown or markup phase is usually the strongest move. Number 4, use a trailing stop on the last step of a scale. So if you're doing a 2 or 3 or 4 part scale, consider using the trailing stop as the last part of the scale, and preferably the lightest portion of the scale. So you've already scaled out of the majority of your position. Let the rest ride with a trailing profit stop on the last step of the scale. And lastly, number 5, consider trailing on the second half of a free trade. So in that free trade example, once we have a free trade and we've sold half of our position, switch to a trailing profit stop and just let it do its thing. And whatever happens will either be zero money or you make money. There's no losing money. Let's look at some examples here. For scaling and trailing, here's a 2-part scale. Again, using CCE as our chart example, we got a very great entry here after the breakout from the accumulation phase, entry at 32.36. Once price went up to our 10-day normal light target of 33.39, we went ahead and took 3/4 of our trade off the table. Once we took that off the table, we began to trail. Our trailing profit stop started on this bar because that's where we liquidated, and now we have a 1 ATR trailing profit stop which we trail for the last quarter of the trade, and you can see that that moved us right up to taking profits just above $34 a share. Our next example, scale out of your position at a cycle high, then trail the rest. So we sell 3/4 of the 10-day at the 10-day normal light target at 65.90, and then we trail the last quarter with a trailing profit stop, right? So again, this is a 2-part scale. We take 10 off, we trail the rest, and we get a very nice move. So this is where we liquidate the first portion of the scale, and since we liquidated on that bar, this bar is when the trailing profit kicks in, and we're in now. Now, what about trailing for big gains? I mentioned before, if you can identify when the market is moving from an accumulation phase to a markup phase, and you can get in at the earliest part of that move, you likely have just identified the next major trending move. If that's the case, whenever you get into a trade at the beginning of that new markup phase with great trade location, go ahead and trail with a 2 ATR stop and just let it do its thing, because it's likely going to remain in the market during that markup phase. 2 ATRs is a big move. It offers a lot of room to run on that trade. But again, if you're in it to capture the biggest part of that markup phase, 2 ATRs, I wouldn't go beyond that. And I would even consider 1.5 ATR. But 2 ATRs will work for you. The thing about this, of course, is you have to make sure that you're coming out of a well-established accumulation or distribution phase. And then you have to get that great trade location at the very beginning of the markup move. From there, just let it trail with that 2 ATR stop, and you're likely going to see yourself capture the bulk of a 3 or 4 month position trade. So I know this comes outside the realm of the swing trading that we've been talking about, but this is a fantastic approach to capturing some big moves. What about the free trade here? We talked about the free trade. Well, this is the same free trade example we talked about, but how about we scale out of that first half and then trail on the second half, right? It's a free trade. Why not trail the rest of the position for a big gain? So, whereas before we had a normal light target somewhere in the bottom portion of this bar, we were able to hang in for a little bit more gain. Not a whole lot, but at least we were in the move for potentially a bigger gain. using a 1 ATR stop. So this would be how you can use just a single 1 ATR stop and you can capture a little bit more of the move. So your entry's here, your free trade zone is here. Once you come here, sell half, trail the rest of the half with a 1 ATR stop. What about this free trade trailing technique? How about you trail with a half, the second half with a 2 ATR stop? This is how you can get a huge gain sometimes. Again, you have to be in an established markup or markdown phase. If you're not in an established markup or markdown phase, trailing with a 1 or 2 ATR stop is not really going to do much for you. It is not. But if we have the same entry here, we have it's the same free trade zone and we sell half, and then we say, you know what? I'm going to trail this last half with a 2 ATR target, or trailing profit stop, not use targets, don't scale anywhere else, because it's a free trade. I'm not going to lose any money. Why not see what happens? And if we're in an established markdown phase and at the beginning of one, I think we can get a much bigger move. That's when you use this approach. Now that we've finished discussing the trade management section, we're going to talk about risk management. Risk management is a very powerful section, and it can contribute the most to your trading future in terms of prosperity, longevity, and the effect it has on your account. When we talk about risk management, we talk about managing the risk in order to stay in the game. And the summary line here reads, trading success is not about how you trade, but how well you lose and how well you manage risk. I'm thinking about tattooing this somewhere on my body because this is the quintessential sentence that you need to remember in your mind, that trading success is not about how you trade. It's about how well you lose and how well you manage risk. Trading is more about learning to lose money the right way and learning how to manage your risk the best you can to optimize your trading capital. When you can do those two things, you can do well in trading. So risk, it's unavoidable, especially when you're in the stock market. You encounter risk. That's why those that can manage the risk the best are the ones that make the best money, the most money. So you must be able to actively control and manage that risk. You cannot control what the markets do, but you can control your money and the risk that you take on each trade. And that's what this section is going to be about. Risk management optimizes your trading capital. Remember that. If you have a $10,000 trading account, a $20,000 trading account, or a $100,000 trading account, it doesn't matter. Having the right risk management approach will optimize that trading capital so that you can trade the longest with the money you have available to you. Take care of your risk first and foremost, and the profits will come. That's another one I'm going to tattoo on myself. That's the one I learned from professional prop traders a long time ago. It's that if you can take care of your risk first and foremost, don't worry about making money at the beginning. Worry about losing the money. Worry about taking care of risk on every single trade you do in a consistent manner. And if you begin to master those components, you'll actually see that the profits just start to come. And I can tell you from experience that indeed is the case. So the risk management topics that we're going to encounter here are the 5 rules of risk management: proper position sizing, defining portfolio risk, and defining trade risk. As a matter of fact, each of these all basically blend together. So there's not going to be a hard and fast sections here. They're all going to kind of mold together because they all are intertwined. And this brings up a great quote from William O'Neill, the founder of Investors Business Daily. And he basically said one time, The whole secret to winning in the stock market is to lose the least amount possible when you're not right. That's the secret. When you're not right, know it immediately and don't take a hit on it. Your job as a trader needs to be to take a loss the right way, manage the risk, lose the right way. That's your number one job. Preserve capital. Preservation of capital is the number one goal of all professional traders, because once you run out of capital, you run out of business. So that's the number one goal. The whole secret to winning in the stock market is to lose the least amount possible when you're not right. Which brings me to the coin toss exercise. The coin toss exercise is used among educators to teach probabilities and is also used to introduce risk management to traders. Regardless of how you enter a trade, risk management is the biggest component to profitable trading. And this coin toss exercise teaches you risk management. So here's the coin toss exercise. There's many variations, and I'm going to tell you a couple of them here, but this is the basic exercise. This is the way I like to do it. Flip a coin 100 times and write down the results of each toss. Each heads is a winning trade. Each tails is a losing trade. Each winning trade makes $200. Each losing trade loses $100. And then tally the results. I did this the other day. I flipped my coin 100 times. I had 49 come up heads and 51 come up tails. So with 49 winners at $200 a pop, that was $9,800 in winnings. At 51 losers at $100 a pop, that's $5,100 lost. I netted $4,700 just because of my risk management. All I did was flip a coin. I had a 50-50 shot at every trade I took. A 50-50 shot at every trade I took. But because I had the right risk management approach, I made $4,700. Well, I didn't really make $4,700, but I did in the example. And that's the power behind risk management. We had a 2-to-1 reward risk ratio, a 2-to-1 ratio there. And even though I was right only 49% of the time, I made money. That should stick in your head. That should be the way you approach trading, with a proper reward risk ratio, with a proper risk management approach. If you think about these things now, your account will be fatter and happier later. So this is the coin toss results. So these are my actual coin toss flipping results. Okay? I flipped the first coin and it came up heads. I made money. Second coin, lost money. Third coin, made money. Then lost and lost. Made. And I started off with a virtual $10,000 account, right? So with a 1-to-1 ratio here, you can see this was the only one that lost money. It lost like $200, something like that. That's a 1-to-1 reward risk ratio. If you use a 1.5-to-1 reward risk ratio, you actually make money. And it made about $2,250. Not bad. The 2-to-1 reward risk ratio, which is the one we traded, is the orange one. And it went right up, and of course we made, what was that, $4,700, $4,800? With a 2.5-to-1 reward risk ratio, that means you're making $250 for every 100 you lose. That's the red. You can see this one made on upwards of $7,000. 3-to-1 made close to 20, and 4-to-1 made nearly $25,000. These are all the exact same trades. I mean, look, when this was a losing streak, this was a losing streak, this was a losing streak, losing. So they're all the exact same trades, but the money management on the back end is what's different. And that's the difference between these equity curves. You need to be worried about trading 2-to-1s and 3-to-1s and 4-to-1s and getting away from everything else. And you have to have that approach, because that's what it takes to consistently win in the market. If your reward risk ratio is not healthy, if it's a 1-to-1 or a 1.5-to-1, when you have these periods of great winning streaks, You need to make money during them. Look at this. You had a great 7 or 8 trade winning streak and it went nowhere hardly. But over here, this 7 or 8 trade winning streak made you probably $4,000 just in 7 or 8 trades. So every time you hit a winning streak, you were making money. As a matter of fact, from about midway over to the far right, that was an entire winning streak in and of itself. And look how much more money you made because that was a 4-to-1 ratio. That's the power of risk management. Now let's look at live application. The next step of the coin toss exercise is to actually engage the market using your preferred reward risk ratio, triggering live trades. This is what prop firms use to teach new traders. You can do this with a simulated account or you can do it live, but this is what professional prop firms use in order to introduce new traders into their prop firm. They say, hey, flip a coin. Okay, every time you flip a coin and it comes up heads, go long. Every time it's tails, go short. Each trade uses a profit target of 2 points. Each trade uses a stop loss of 1 point. Calculate your results. Now, of course, this is usually done with minute bars in a future that has a lot of volatility and liquidity like the ES. And 2 points, 1 point might be kind of big, but you get the point. For example, when you do an approach like this, it's doing so many things for you. First, it's telling you that it's not about how you get into the market. How you get into the market is a very small percentage of how good the trade's going to turn out. It's about your risk management at the end. It's about your trade management. If you employ the right reward risk ratio, even by flipping a coin, you can make money or not lose that much money. So when people do this, you're not going to do this 100 times, but prop firms will say, hey, you're a new trader. We want to teach you about our approach to trading the markets. We're going to introduce you to risk management. We want you to flip a coin 10 times. Okay? And we want you to finish this in the first 30 minutes of the market. Flip a coin 10 times. Let price go in your favor 6 ticks or lose 3 ticks. Okay? Do it 10 times, see what happens. Come back to me and tell me the results. What this is doing is it's taking the emphasis off of your entry and putting the emphasis on risk management. It's also teaching you to apply risk management in a machine-like routine, without emotion, without deviation. You just become a machine. You place a trade, you put on your risk management, you don't touch it until it's done. That's the discipline required to play out risk management in your trading. That's the discipline required in order for you to have longevity as a trader. That's the discipline required for you to have success as a trader. So I would ask that you try this exercise either with live money or simulated trades. Remember, the goal is not to try to knock it out of the park. The goal is place a trade with a coin toss and let it go 5 or 6 ticks in your favor and then cut it in half as your stop loss. See what happens. Prop firms also use this to allow you to test scaling techniques as well, or trade management. So for example, scale after the first 6 ticks, one part, and then scale, let the rest ride, or whatever. So I mean, there's different ways you can do this as well, but this exercise teaches you risk management, and it teaches you to rely on risk management as the way to success. Let's talk about the 5 rules of risk management now. Of course, there are a variety of ways that you can go about risk management, and there are a variety of rules. I mean, if you look for rules for risk management, you might come up with 20 rules, but these are the 5 rules that I would talk about here with you, because I believe these rules will help to set a risk management approach that you can begin implementing immediately. Risk management is the most important aspect that separates professional traders from everyone else. Risk management is the holy grail in trading if there ever was one. It's all about managing risk. Number one, use the 2% rule. And we're going to talk about what this is in the next slides. But the 2% rule is basically an approach that allows you to define portfolio risk, define trade risk, and it really helps you optimize the trading capital you have. It is an all-encompassing money management, risk management approach. Number two, use a predetermined reward risk ratio and stick to it. If you're using 2 to 1 right now, experiment with using 2.5, 3 to 1. Always require 2 to 1, 3 to 1, 4 to 1 reward risk ratio. Whatever it is, use it and stick to it and don't deviate, because it's that consistency that leads to consistently profitable trades. It's that consistency. Number three, always know your exit and your risk before you enter a trade. So before you're entering a trade, you have to have that ADR stop calculated. You have to know what your risk is going to be. You have to know where your exit point's going to be, what your potential targets look like. Everything has to be done before you enter a trade. Because once you enter a trade, your brain goes nuts. The clarity is gone. You're not thinking straight, and you do weird stuff. Once you have money on the line, weird things happen. So do it all beforehand. And once you place the trade and set all your stops and targets, don't touch it. Leave it alone. And let the trade do what it's going to do. Number four, never add to losing positions. This is an easy one, but there's still a misconception out there that if you enter a trade and it starts going against you, the good thing to do is add more to the trade. And it starts going against you, and the good thing to do is add more to the trade. This can work, but not for you. And I mean that in the nicest way possible. The reason this can work is because institutions, hedge funds, institutions with ginormous accounts, $500 million trading, $1 billion trading, those are the ones that can keep adding to losing positions because they have the money, and because they have the money to influence price in that way. You, on the other hand, do not have the money, most likely. I know I don't have the money to just sit there and keep pounding these trades and trying to hold up my position. I don't have that type of money to hold up a position by myself. So that's why it's a losing proposition. Number five, limit your losses to a daily amount. After you've lost X amount of dollars for the day, stop trading. And you have to make that determination of what that amount is, given your risk profile, given your trading account size, etc. But limit your losses to a daily amount. So for example, you may say, after I lose $500 for the day, I'm done. Or after I lose $800 for the day, I'm done. And stick to it. Turn off the computer. Tell your wife to change the password on your brokerage account and not tell you to tomorrow. Do what you have to do in order to stop trading, because that's when trades snowball and get worse and worse and worse. If you'd have just stopped trading at your $500 limit, it wouldn't be $2,000 right now. Suddenly that $500 loss looks a lot better, doesn't it? Let's talk about defining portfolio risk and proper position sizing now. And this all goes down to the 2% rule. I've already mentioned the 2% rule several times over the last 20, 30 minutes, an hour maybe, and now it's time to actually learn the rule. It's a very simple rule, but it's a rule that can change the way you trade for the better. The 2% rule is a basic tenet of risk management, and it's used among professional traders. And basically, the 2% rule says that you should risk no more than 2% of your trading capital on any one trade. That's risk no more, not trade no more. Risk no more than 2% of your trading capital on any one trade. What this rule does is it optimizes your trading capital the most. It provides a consistent and easy risk management approach that you can use in your trading starting today. While 2% is the rule for professional traders, retail traders should also consider 1%. And again, that goes back to the money that they have. 2% is what's used among institutions and prop firms and all those other folks. But that's because they have tons of money. 2% is actually quite a lot when it comes down to retail traders' accounts. But again, it's not a huge amount. You should never go past 2%. But you should consider using a 0.5%, a 1%, 1.5%, whatever that number is. But 2% is what I use. But if I am in trading in an uncertain environment or a volatile environment, I can drop that down to 1% as well, or not trade at all. And basically what's great about the 2% rule is that this is almost an all-encompassing risk management approach. The 2% rule encompasses portfolio risk management, position sizing properly, and proper trade risk. And that is fantastic. If you employ the 2% rule, you'll need 194 losers in a row in order to blow out a $100,000 trading account. And I know I've seen bad traders in my day, but I don't think I've ever seen a trader bad enough to lose 194 times in a row. That's what it would take. This is a graph here that shows a fixed risk approach with a $100,000 starting capital. This is the number of trades, and this is the percent risk of the account size. So a 1%, this is a 1% rule, or 1% of trading capital. It would take you 390 trades to blow out in a row. 390 losing trades in a row to lose $100,000. For 2%, that's 194. But you see, as soon as you start going up, that percentage goes way down. 5% is a huge amount to risk on one trade. And that drops you down to 77 in a row. Some people, me included at the beginning of my career, I would risk the entire account on one trade, basically, or a half of account. You can see here that if you risk 20%, 19 trades, you're done. And I know, I've been there where I've lost quite a bit of trades in a row early on in my career. I mean, I don't remember exactly how many, but 6 or whatever. That's a third of the way to blowing out an account if I did that 20% approach. So this really shows you the effect of proper risk sizing. The fixed risk approach really, really can do wonders for optimizing your account. 20 trades, 19 trades to blow out $100,000 is not optimizing an account. But 1 and 2% is. So let's talk about applying the 2% rule now. The 2% rule is easy to incorporate in your trading plan, and it will help you establish a consistent implementation of risk management. The 2% rule basically says that you should risk no more than 2% of account value on any one trade. And very much the same as how, we talked about, ADR stops before. This is how you would calculate, your risk here. Basically, you would calculate 2% of your account. So that's number one. What is 2% of your trading account? That's your capital at risk. So if you have a $10,000 account, you can see to the right, that's $200. If you have a $20,000 account, that's $400, and so on. Number one, calculate 2% of your account. Number two, subtract the trading commission and slippage from capital at risk. So basically, if it costs you $10 to do a round turn, or whatever that number is, subtract that $10 from your capital at risk. If you're going to incur some type of slippage, or you routinely incur some type of slippage, factor that in as well. So if for a $20,000 account you have $400 as your capital at risk, your maximum permissible risk then becomes $400 minus commission and slippage. So that comes out to maybe $380, $390. That's your maximum permissible risk. Now, calculate the difference between your entry and your stop price. That's your risk per share. Now, divide the maximum permissible risk by the risk per share, and that tells you how many shares you can trade. That's it. That's all you have to do. Now keep in mind, after every trade, you have to recalculate what your 2% is, because each trade will move your balance higher or lower, which means your 2% will be different for every single trade. And that's okay. So let's look at the 2% rule in terms of examples. Example number one is a $20,000 account. Capital at risk, $20,000. 2% of that is $400. That's your capital at risk. Maximum permissible risk is $400 minus commission and slippage. Let's say $390. Okay, that's your maximum permissible risk. Now your risk per share, that's your entry price minus your stop price. If you have an entry of 25 and your stop is 23.75, that means your risk per share is $1.25. Okay, divide 390 by 1.25. That tells me that I can trade 312 shares, and if I stop out, I will lose $400. And that is exactly 2% of my $20,000 account. And that is okay. That's a good approach to trading. That's a solid approach. If you use 1%, of course, that's even better. But that's how you calculate it. Let's look at example 2, $50,000 account. Capital at risk, $1,000. $50,000 times 0.02 gives you $1,000. Maximum permissible risk is $1,000 minus commission and slippage. That gives you $980 as your maximum permissible risk. Divide 980 by your risk per share of 1.75, and that gives you a maximum number of shares you can trade of 560 shares. If you stop out on the full amount of those 560 shares, you lose $1,000 only, which is 2% of your account. That's how you employ that rule. This is the underlying tone of employing this type of risk management approach. It's do not think about how much money you can make on a trade. Instead, think about how much money you can lose if you are wrong. That's the difference between a retail trader and a professional trader. Professionals think about how much money they can lose if they're wrong. Retail trader thinks and dreams about how much money they can make if they're right. That's the difference. Now when we're talking about 2% rule and ADR stops, this is where I talked about earlier that using ADR stops, ADR targets, that whole 9, really help to easily incorporate the approaches together. ADR stops allow for an easy way to incorporate risk management measures like the 2% rule in your trading. Using the 2% rule with ADR stops is very simple. Basically, it's the exact same as what we just did. Calculate 2% of your account, that's your capital at risk. Subtract your trading commission and slippage from capital risk, that's your maximum favorable risk. Now, calculate the current 5 or 10 period ADR. Once you get the ADR, divide the current ADR by 2. That is your risk per share. Remember, 50% of the ADR. Now, maximum permissible risk, divide that by the risk per share, and that gives you the amount of shares you can trade. Of course, you recalculate after every trade because your balance will change. That's how you incorporate ADRs with the 2% rule. Now let's talk about getting started. We've talked a whole lot about risk management and trade management, and I've talked about a number of approaches. I've thrown a lot at you. I want you to start somewhere, and I want you to start quickly. I don't want you to feel overwhelmed with how to incorporate all the various things we've talked about over this 3-part course. What I want you to do to get started with proper trade and risk management is follow these 3 simple steps, because even the simplest form of trade and risk management is better than none. So to get started, the 3 steps to follow are, number 1, start using the 2% rule with ADR stops. So start incorporating the 2% rule in your trading. Again, if you are a trader that has serious issues with consistent trading or losing money, then start with a 1% approach. and work your way up. Step 2, use the free trade technique with ADR targets. Again, if you're a trader that is very inconsistent in your approach, use the free trade technique. It's going to teach you how to trade in the proper way, with risk being the #1 factor. The free trade technique will get you free trade time and time again, especially if you're identifying the setups that we talked about in parts 1 and 2, especially if you're using the entry techniques that we talked about in part 1 and 2, you're going to get great trade location based on what we've learned in already the parts 1 and 2 of this course. Getting a free trade should be fairly simple for you now. And if you use this with ADR targets, you're going to do just fine. And step 3, start with a reward risk ratio of 3-to-1. Every time you trade, make sure the ratio is there. At least 3-to-1 every time. Because the moment that ratio starts to deviate and you start trading 1-to-1 and 1.5-to-1 and etc., or going upside down, or letting a trade go against you because you pulled a stop and all of a sudden you just traded with a reward risk ratio of 1-to-7, I mean, that's when you start blowing out accounts. So make sure the ratio is there and stick with it. But if you follow these 3 steps, you're on your way to profitable trading, to responsible trading with proper trade and risk management. So here are my final thoughts. Trade and risk management do not provide the sizzle of some other aspects of trading, but these can affect your bottom line the most. And that's both in a bull way and a bear way. Because if you don't have the proper risk management and trade management, it's going to affect your bottom line in a very negatively way. But if you do employ these techniques, they're going to be the biggest assets that you've added to your trading regimen. This approach will help your trading. Trade management relies on a predetermined plan. So you have to build your plan and you have to stick to it. Too often traders are inconsistent with their approach. They don't have a trading plan. They don't have a business trading plan. And that's what you have to build out and stick to. And every once in a while you monitor your plan and adjust it and improve it as you see fit. Risk management. Risk management is the holy grail of trading. That is the holy grail that everyone looks for. The problem is nobody wants to believe it because it's too much work seemingly. But you know what? It's all about risk management. It's the most significant contributor to consistent profitability and longevity in your trading career. Develop your risk management approach and stick to it. Consistency is key to a winning solution. So once you build your plan, stick to it. Don't deviate. Don't let one bad day lead to scrapping the entire plan. These techniques that we've just discussed in this part of the course are very powerful. Do not underestimate what they can do for your trading. And that concludes the 3-part course, Swing Trade Pro. It is my sincere hope that the concepts and techniques that we've covered in this 3-part course will serve you well in your trading career. For Pivot Boss, I am Frank Ochoa, wishing you the very best in your trading.